This is Boxes and Briefs, a podcast with real-life business stories. But we will be asking the hard questions and challenging traditions. So broaden your thinking with fresh perspectives and solve problems for business success. Hi there, welcome to another episode of Boxes and Briefs. My name is Lisa Garrett.
I'm Tori.
And today we're talking about getting out of debt. Adam, welcome to the podcast.
Thank you very much.
Can you tell us a little bit about yourself, why you're here, why you're talking to us about this particular subject?
Yep. Well, I'm a mortgage broker at the moment. I deal with residential and I also deal with business loans and clients. But my background is very mixed, and that's how I've ended up where I am. So I'm from the UK.
I was going to say there's an accent there.
Yeah, there's definitely an accent. And I've got a degree in chemistry, which bears no resemblance to my life these days. I joined the army, did 10 years in the army.
Wow.
Left the army, got a full-time MBA, and then I joined corporate banking. So I joined one of the biggest banks in the UK, Barclays, on a leadership scheme.
Okay.
But I got in just before the GFC, and it all went very, very crazy during GFC. So we got into the business and were told the program is cancelled, so you're on your own. But it turns out that was a blessing in disguise. So I moved into managing clients and was looking after clients with a sort of turnover of 10 to 100 million Kiwi dollars. So pretty sizable clients. Yeah. Looking after all their banking needs. And we came over here 12 years ago. I've worked for ANZ and also for Kiwi Bank in the commercial space. So I've got a lot of experience of commercial lending. And then in the last 4 years, I've been working for myself as a mortgage advisor. So a lot of experience of residential, personal, but it all bleeds in commercial and residential.
What a journey.
Yeah, it has been a little bit of one.
So with that completely vast array of different types of backgrounds that's fed into what you do now, why do you do what you do now? Why do you get out of bed in the morning?
Yeah, I enjoy solving complex problems. I'm a numbers person without doubt. I love numbers. So I was always going to end up doing something like this, and I like meeting people and finding solutions that, might not be immediately apparent, and then taking that, what can be quite complex, and turning it into simple terms to present to a lender to find the right solution for a client and to see how that plays out.
It is an unusual combination of numbers and people.
Yeah, it is, but it's actually what we do. I mean, anyone in this sort of industry, it's all about building relationships, but then finding what can be sometimes quite complex solutions, and then fitting them into the boxes that banks give us, or sometimes just outside those boxes.
See what we can get away with.
Yes.
So we're talking about getting out of debt, and we'll start with the basics. What's the common sense tip?
Oh gosh, well, the common sense tip with debt is have a plan. And I know that is what everyone says with most things in business. True. But if you don't have a plan, it's not going to happen. And people get themselves into debt, and businesses get into debt without having a plan. But you are not going to get yourself out of it without having one.
Yeah.
So you mean have a plan so that you don't get into debt, or once you're in debt, have a plan to get out of it?
No, well, I mean, things happen. So ideally, you have a plan, you have a business plan. You know what you want to achieve, how you want to achieve it, and your sort of timeframes for doing that. And therefore, you're not going to get yourself in a situation where you'll be in an over leveraged position. But it happens. Business revenues drop, which means you haven't got enough to pay your debt. And so what you need to do is sit down and get a plan. And that can be, with your advisors, your accountant, your lawyers, your bank, mortgage advisor. But it's about sitting down and having a plan.
Yeah, I think the worst debt is the ones where you go, I'll just do it, I'll figure it out later.
Yeah. Well, I mean, most people I find who get themselves in real problems is because they just put their head in the sand. Yes. They think it'll go away. And when someone's owed money, they don't go away.
Yeah.
I've got so many mates like that.
Yeah, but it's not just putting your head in the sand because you hope it'll go away. It's putting your head in the sand because you don't know how to deal with it.
Yeah, much. You're absolutely right. And I think that leads on to communication. So if you don't communicate with those people or organisations that you owe money to...
it gets worse.
It gets worse. Yeah. And the IRD is a classic example. I mean, a huge amount of businesses that we see struggling is because they're late with their IRD debt, or they don't pay the IRD and they just don't do anything about it. They don't communicate. And so it's imperative that communication. I mean, if you get cut off from one of your main suppliers because you haven't communicated with them about, the payments you owe,
Yep.
it will destroy the business.
Yeah. Everybody gets their pound of flesh, so do it before that happens.
Absolutely.
Yeah.
Absolutely. And, in some situations, the RD can be very forgiving if you are upfront, honest, and you stick to the plan that you arrange with them.
Yep. The communication as well.
Yeah.
Keep
So
talking.
it's really important. So I think those two things are vital. The one thing that people do, which sometimes can get them in a worse position, is reborrow. You go to a sort of a lower tier lender to try and cover the initial debts, and it just spirals out of control. It can work in some situations, but other cases it can get you into all sorts of trouble, which is really, really hard to recover from.
Yeah, I think the common one for personal debt is move your credit card to us and get 0% for however many months.
Yeah.
And then suddenly they've got you. You haven't done anything for the however many months the offer was on for, and you're back in the same spot.
I mean, businesses do that, so they'll go to their lender and get an overdraft because it's access to, not a significant amount of money, but enough just to tide things over.
Yeah.
But then they draw down the overdraft, and then they're in a worse position than they were because they're also paying 15-20% interest on that overdraft as well as the debt they already owe. So it just mounts up really, really quickly.
Yeah.
And you don't want to be a business that is operating purely to pay interest on the debt you owe. And that's what happens.
Okay, so debt in New Zealand, what is the thing that you see coming, the trend, the thing that...
Well, yeah, it's interesting. I think in the UK, they have open banking. And so this is where basically all of the banks need to open their sort of client databases securely to third-party providers. And so what it means is there are a lot of smaller businesses, a lot of fintech banks and lenders who are in the market who have access to client information in real time. And so it has kind of blown apart the UK market. There are banks that didn't exist a couple of years ago. Now, forming up a bank is incredibly challenging, but there are banks that exist now that didn't a couple of years ago.
Right.
And a large number of them. They all offer slightly different pieces of the puzzle for the market. And we have got open bank coming.
Okay, so open bank means that like ANZ can see Kiwi Bank's customers.
I mean, it's done so, for example, if I wanted to go and get a car loan from Car Loans Limited, I would go to them and I'd say I want a car loan, and they could then access all of your information with your banks to see what your position is. So you don't have to go in and prove everything the way that you do currently.
Is it kind of like a credit score, but not like...
Yeah, so I mean, I don't know exactly how it operates, but I know that all the information is available in real time, which means that effectively you can make a decision very quickly. And so it opens the market massively to other providers.
So I do think there's a way a lot of people get around things like that by, they'll have an overdraft here, a credit card there, and then they'll get a car loan, and they're just trying to get everything done, and they end up further in debt, a hole that they can't dig out of. And it's just not, it kind of needs to be regulated. So I guess that's what open bank would bring.
Well, I mean, not so much the regulation side of it, but it offers real-time information. So even if you go to a bank to get a home loan, you're providing them statements which are, up to 2 months out of date. So you're not operating things in real time. Businesses are, their cash flows highly fluctuate. So real time is really important to make sure the information is accurate. And at the moment, we've got a couple of lenders which have come from Australia here, which only focus on the business space, and they will make decisions very quickly. And I think it's the speed which is something that's going to improve as we move on, because banks can be incredibly slow. They can be fast, but with business it is slower. And so, the difference being, you go get an overdraft from a bank and it might take you 4 weeks to get it all approved and set up, and you can go to a provider and get it in 24 hours. And I think this is going to increase as we move forward. So I think there are about 40 lenders in Australia who are currently operating in that space, and we've got 2 at the moment here.
Okay.
And so, we are sort of ripe for a little bit of
zhuzhing up.
Little old New Zealand. We'll get there.
It is, and it's frustrating because there's no middle ground. You've either got institutions on one side, and then these sort of small, fintech organizations on the other side. There's no kind of middle ground, but the market will fill out.
Yeah. Okay, well, in my Kiwi upbringing, I've been taught that there's good debt and bad debt. Good debt would be my education. It would be investing in a property for my retirement, something like that. That would be considered a good debt. So I'm sure there's the same thing in business. What's the difference between good debt and bad debt in business?
Okay, so good debt, there is a purpose. So whatever that purpose is. So if you want to operate out of a commercial property, you would either lease it or you'd buy. Now, a lot of businesses lease, but borrowing to buy that commercial property can definitely be considered good debt. You're going to increase the value of the business because you've got somewhere that you're going to operate out of for however long in the future.
Yeah.
And at the same time, you're producing an asset for either yourself or your business into the future. And it's the same for if you want to buy a truck, you go and get a truck loan. You don't use your cash flow or your working capital to do that. Bad debt in business is the way you use something. It's not, people would say credit cards. If you have a credit card and you don't pay it off each month, that's not a good position to be in because you're paying significant interest on it and it can, compound. With businesses, credit cards tend to be debited monthly by the banks anyway, so you don't get into the same sort of position. But it's using, for example, your overdraft in what's called hardcore, so fully drawn, and you never get your overdraft back into the positive. So business overdraft should always fluctuate between positive and however far you need to use. A lot of businesses don't. They draw down their overdraft and that's it. Then they use that as the sort of point zero when they're at the bottom of their overdraft.
New zero. Yeah, I've heard the same said for savings. Like, many 100,000 should be your zero, just in case something happens.
Yeah, absolutely. You've got to cover, whatever might happen.
Yeah.
And then what happens? The business then goes to the bank and says, I now need a temporary overdraft, and they have to increase their overdraft to cover these temporary fluctuations, which should be covered by the overdraft. And so that's not a good position to be in. And the other bad debt is when you have a loan that's structured but doesn't meet the structure of the asset. And what I mean is if you buy a truck, your truck it's got a life of 7 years, and at the end of 7 years, because you've been driving down to Wellington every week in it to do deliveries, it will be dead, effectively dead. If you borrow over 10 years for that truck, it will keep your cash flow lower because you're not paying as much in terms of your monthly payments. But at the end of the life of the truck, you've still got 3 years worth of loan to pay.
Without a truck.
And actually what you've actually got is a new truck because you've borrowed again for the new truck to be able to replace that truck. So now you've got 2 loans that you have to repay. So it's about structuring the loans over the life of the asset. When I left banking 4.5 years ago, the standard length for an asset finance loan for a vehicle was 5 years. We're now at 7. So even though the life of these assets is not getting longer, lenders are pushing out slightly because there is a need for payments to be slightly reduced from where they were, just because businesses need cash flow.
Yeah.
I mean, the worst thing you could do is borrow and then you run out of cash because you've borrowed for an asset that you need to run your business.
True.
So, I mean, those are pretty bad examples of how businesses can use debt in a way that's not efficient.
Yes.
Yeah. Leverage is important for businesses.
Yeah.
It's how you can grow.
Yeah.
It's just using it in the right way.
Yeah. Got it.
I kind of have it. Not really.
Oh, really?
Oh, honestly, like numbers and all this shit just goes straight past my head, but I'm trying very hard.
I think it's important, and it's exactly the same if you go and get a car loan. You don't want to borrow a car loan, which a lot of people are at the moment, over 30 years, and they put it on their mortgage because however long you keep a car, it won't be for 30 years.
No.
I can guarantee that.
Yeah.
So at some stage you'll be left with a loan and no asset. And it just, again, it starts to turn into a position that just grows and grows.
Yeah, true. It just gets out of hand.
Yep.
Yeah.
Boxes and Briefs is proudly brought to you by Gilligan Shepherd, the problem solvers in business.
Okay, Adam. Depending on your company structure, whether it's sole trader partnership, limited liability, personal guarantees, all that kind of stuff, somebody is ultimately responsible for business debt. So we feel like it's story time. Tell us about one of those times where it kind of all went wrong.
I can tell you about quite a a sad situation for a business, but it was for a B2C. So when they had or business to customer. So when they had an order, they would get a small deposit in, and then they would have to fund the production of these units, ship them in from China, and then install them, and they got the remainder of their invoice. We had to fund quite a big working capital facility for them, and it was unsecured, which means that it's secured by the cash flow of the business, along with a personal guarantee from the owner. Which I mean, there's no way you'll get away without signing a personal guarantee, but it puts you on the hook. Yeah. Now, worst case scenario, it was terrible, but the owner died. Oh. And the business debt was effectively passed into the estate. And it was, I mean, we're talking about 1.2 million that was effectively given to the children. And there were these 3 kids who were had no involvement in the business. They didn't really understand a lot about the business. One of them was overseas, and they were left in this situation where they had inherited a good business, but with significant debts. And then it was a case of working through that scenario. So at the time, with the bank I was with, we partnered with one of the big accounting firms to bring someone in to advise them and get to a situation where either the business would continue to trade as it was, and we would hand over or assign the debt to those individuals, or the business would sell. And it was a really stressful 9 months for the family.
No, imagine that. Like, not only do you find a way that your parent has passed away, now you're lumbered with $400,000 of a bill to pay.
So what did they end up doing?
They ended up selling the business.
Oh, they ended up selling the business.
And I mean, there were a number of things that conspired against them during that period, but they ended up selling the business, and they had to put a little bit in each to cover the remaining debt. But it could have been a lot worse. And so, and this is the sort of thing, I mean, unfortunately, despite the advice that the business owner was given, he didn't take out any insurance. So there are various different insurance policies you can take out as a business owner. And normally, for someone like him, you know, I'm not an insurance advisor, but you'd think of some sort of key man insurance, and normally that would cover the debt. That's the idea.
Right.
Is if the key person is no longer in the business, if you cover the debt, then at least the business can function without having to worry about this big obligation.
So that's the lesson learned, is take the advice that you're given in the first place.
Well, it was. I mean, I understand why he didn't, because he was slightly older and the insurance was expensive.
Right.
But it would have left his family in a very different position. And so, you know, it's one of those things that with risk insurance, you make you sort of balance up the pros and the cons, and you make a decision, and that was his decision. But I mean, and that sort of scenario is horrible, and it happens, you know, more
often than you
than
think.
people would like to think, because people do unfortunately die. And it leaves all those around in the business in a pretty challenging situation. Yeah. And equally the lender, I mean, you know, they're under pressure.
So when does the risk seesaw change? Like, you need to borrow to grow your business. What are the indicators to look for as to when that's the right time?
There's no right time. There are definitely wrong times, I would say. But if there is a need, and small business owners especially, I find they want to borrow because they're like, I've got to do something. I need to grow. I need to, you know, and that's why they just want to borrow.
Right. Yeah.
Whereas, first of all, there are different types of access to funding. You don't need to borrow. You don't need to create debt. You could offer equity in your business, get an equity investor in, you know, rather like the Shark Tank or Dragon's Den. So, you know, you actually offer some of your business. And there are plenty of people out there, and business angels out there, who are very, very willing to be involved, offer their experience. And that's what they're bringing. They're bringing money, but they're bringing experience, really, which is the most valuable part of it. Yeah. And then, obviously, there's debt. And there are different ways that you can structure both of those to maximise the needs, but there has to be a need first of all, and so
like needing a new truck because you've got a new contract.
Absolutely. So a new asset to work in the business, or something to protect the business, so commercial property, to give it that sort of longevity, not having to move every 5-10 years, or some sort of project, some innovation that needs to be done in the business, or people but there has to be a need. And I know that sounds like a really basic thing to say.
But it's
you'd be
so
surprised.
easy to get your needs and wants mixed up.
Yeah.
Yeah, it's like
Yeah.
my shopping addiction.
Yeah.
I
There
need
we
it.
go.
No,
Must have it.
exactly.
Well, that's what
I've
my
actually,
daughter says.
yeah, and you can always find a reason why you actually
Yeah.
do need it.
Yeah. And you know, when I talked about planning earlier on, and I have seen in my banking career, I don't know, 100 business plans, probably 100 plus business plans from prospective business owners through to business owners, through to very big business owners. And they talk a lot. And normally, you'll be very happy to hear, normally the marketing piece is normally about, 30, 40% of the business.